Okay, hello everyone. My name is Lou Kerner and I'm CEO of Big Token, and we're an app that lets users own and monetize their own data. And I'm excited for our webinar today titled SPACs Are Back, because as I'm sure everybody on this call knows, SPACs came roaring back in 2020, and it looks like 2021 is even going to be a bigger year. And if you're like me, you're really wondering what exactly is going on. SPACs have been around for, about 25 years, and they've had some ups and downs, but they've never had anything like the last about 18 months that we've seen. And I'm super excited to be featuring on the webinar today, Michael Jones with Science Inc. This is, I think, the third time I've had the opportunity to do a fireside chat with Mike. The last time, I think, was at Start Engine's LA crypto-focused conference in 2018. And Mike is truly one of the smartest people that I know in tech. And it's always a pleasure to talk with him, and always a pleasure to do a fireside chat with him. And I invited him here today because last month, Science floated their own IPO for a SPAC, and he's out there now searching for a company to acquire. And so the idea of the call today is to have Mike give us a background on how he got involved in SPACs, and Mike will talk, and I'll ask some questions, probably for about 15 or 20 minutes, and then we'll open it up to questions from the audience. So if you've got a question, put it into the chat function on Zoom, and if we pick your question, we'll chat back and we'll let you know, and we'll actually invite you up on stage as a speaker. So you'll open up your mic and your video, and you can ask Mike the question yourself and any follow-up questions. And so with that, Mike, welcome, and I am going to make you a host. Let's see, so that you can share your screen if you want to.
I don't have a presentation, but you can share my video. Okay. How's that?
Okay, there you go. Then I don't need to make you a host. So welcome, Mike. Super excited to have you on. It's been so long since I've seen you.
I know.
The beard is new. So where are you? I'm dialing in from Wayne, New Jersey. How about yourself?
Oh, nice. I'm out in Aspen, Colorado. We kind of moved to our vacation house out here and just been hanging out here for the pandemic.
Wow. So I imagine you've got some nice snow there.
We have great snow. It's been fun, and it's been neat to exchange my normal 2-hour commute daily with 2 hours of snowboarding every day. So it's been a good change, I think.
I'm very, very jealous. Would be great, for those who don't know you, if you could just kind of give a quick background, because it's pretty illustrious.
Thanks. Well, it's been a fun journey. I started as just an early stage entrepreneur, building my first company in college. I built a few companies before I kind of had a good hit, which was one that was sold to AOL. That was probably my second or third business. I spent 2 years working inside AOL and kind of learning what it was to have a real job and be inside of a big organization. Became a really active. Oh my God, dude, Lou, I have no idea. Like, that feels like it's so long ago. Was that 15 years ago? Like, I don't even know. And then I started angel investing back then, which is probably when you and I started meeting and talking, and became a pretty active angel. Eventually, I was recruited to go work in some distressed assets within private equity, which was super fun, kind of mid-stage businesses, maybe 100, 200 people. And then I was recruited to go run Myspace when Myspace had been acquired by News Corp and was facing challenges out of Facebook, kind of a bigger distressed asset challenge. Again, kind of investing my own capital along the line. And then after we sold,
let me just before you move on from there, because
sure.
That was because at the time I was running Bolt, which was the largest social network in the world before Myspace blew by us. What did you have any kind of macro lessons that you took away from Myspace? Because for a while, obviously, and that was before you got there, but it was totally the center of the of the internet public company. It had a skyrocketing stock. Fox paid, at the time, would seem like an enormous amount of money. For the asset, but and by the time you got there, obviously it had peaked, and Facebook was on just beginning its amazing run.
Right. Yeah. I mean, big takeaways for me. One is like, I think if you think about the progression of these social networks, for me it started with 6 degrees. and then to Friendster, and then kind of the MySpace. It was like 1 million users, 10 million users, 100 million users, and then obviously Facebook at 1 billion. I think that it took a long time before, people were comfortable putting their real information online. I mean, at the point of me coming to MySpace, we're still at a world where most people are using fake names and weird pseudonyms, and still concerned about putting credit cards into forms. And I think it took a while before we realized that the internet was a safe place to actually have identity in whatever construct you consider it. And I think at that point, when Facebook came out with real verified identity, starting within the college campuses and expanding, there was really just no contest with a social platform that had built itself over kind of fantasy identities or speculative identities or aspirational identities. And so I think that at the heart of it was a really hard battle. And even though MySpace tried to move into real names and real information, it was just too late. I mean, I think it had a big legacy behind it. It really wasn't, prepared to compete there. I didn't think we could change that DNA. And after we spent a lot of time and money trying to, our recommendation to News Corp was we should sell it off for pieces.
And now the company that bought it recently went public.
Did they really?
Yeah.
Oh my God. It's gone through a lot of transactions there. Yeah, exactly.
So cool. So continue.
So then, after MySpace, I wanted to return to kind of like core investing, working with management, growing companies. And so I founded Science with 3 other partners. So there's 4 of us really at the core. And we really take this kind of, we invest on 2 ends of the spectrum. So hyper early stage founders with initial visions that we can help construct and invest behind on the venture side. And now the very late stage, that moment, pre-IPO, post-IPO, at that SPAC vehicle. And I love these 2 components of the spectrum, and that's where I spend my time.
So let's talk about Science for a bit, because that's been obviously a great run. What did you kind of start with, and how has it evolved? And why don't you talk maybe about a couple of your your big successes?
Sure. Yeah, we started with a $40 million vehicle. It wasn't structured, quite like a traditional fund. We got involved very early in businesses, and we were really fortunate that in year 4, one of the companies that had kind of been founded in our office, which was Dollar Shave Club, sold to Unilever for about $1 billion. Meaningful exit for all of our investors, meaningful exit for obviously Dollar Shave Club, and was really one of the kind of pioneering brands behind the direct-to-consumer movement, all led by an incredible CEO named Mike Dubin. And then, what's even funny is one of our companies, a company called Dog Vacay, had merged with Rover, and
I think of it as kind of the first viral video, right? A direct-to-consumer viral video that come about.
Yeah. So exactly. So that was Dollar Shave Club, right? Yeah, that viral video broke out that brand, right? And really also showed that YouTube could launch brands, which was cool. But yeah, on the other side, we had originally also helped start and invest in a business called Dog Vacay, merged with Rover, and Rover just announced that they're going through their own de-SPAC process. So, 10 years later or 9 years later after the beginning of that one's now seeing realizations, and all that kind of came from that initial Science 1 vehicle, which was the initial start of how we kind of got into formalized investing.
And how is it involved? Because I started my career on Wall Street, was an analyst, and left to become part of the Idea Lab ecosystem in 2000. I was a 55th CEO in the Idea Lab incubator. Still, it was a massive highlight of my career to be a part of that, amazing ecosystem.
Nice. Yep.
So how has Science evolved since its beginning?
I mean, it started truly as like a studio incubator, very similar to Idea Lab. It now is a formalized venture fund. So on the early stage side, we went from a $40 million vehicle to a $75 million fund, and now we have a $100 million fund 3 that we're closing off right now. That they are all focused on a lot of the same principles that you probably saw at Idea Lab. How do we bring resources to help those founders grow their businesses? How do we bring talent and skills and operational pieces and to that story to help construct those companies? So on the early stage side, we have an incredible team. They look at 3 or 4 deals a day. We'll probably have about 30 companies that come in our portfolio, but 10 companies per year that will work with that management to try to build those next big breakout consumer businesses. And so very similar to probably the DNA behind Idea Lab, maybe a little bit of a nuance of a structure. As far as LPs are concerned, it's a traditional venture fund, but I think through the lens of the CEO that we work with, it's a really strong operational partnership that we help build those companies.
Wow, super. And so, let's start talking about the subject of the day, SPACs. When did you first become aware that even SPACs were a thing?
Well, we came across them 5 or 6 years ago when we were looking to kind of find a way for one of our companies to end up in the public markets. And we ended up talking to a bunch of banks that were running SPACs. And probably just as you remember at that time, they were kind of seen as these, less attractive backdoors onto the public markets and kind of a way you wouldn't really want to go public and not as favorable. We looked at it. We didn't end up really doing anything, but we became pretty well informed around how they worked. And then, all was quiet, I think, until our friends, Chamath and Adam Bain and Dick Costello pushed out the Virgin Galactic SPAC. And it was funny because I think our team was like, gosh, we looked at those things a while ago. It's really interesting to see that, high quality, investors are really using these. Then we actually realized that a bunch of the other VC firms we had been working with had been using them for quite a while. It just hadn't really been that public. And so we started talking to bankers and finding whether or not our strategy would really fit. The conclusion was that it would. And then obviously we decided to pursue our own SPAC.
And so can you talk about, it'd be interesting about just even starting, how do you pick a banker? How did you, obviously I assume you've got lots of banking relationships, but this is, still, I think of it as a specialty.
Yeah, I think that's true. So, we interviewed a whole series of bankers. We're working, we obviously, our DNA is really on this direct to consumer world, both, products, brands, marketplaces, mobile, et cetera. We're looking for bankers that have deep connections within target companies and investors that would be receptive to that sector. We obviously, those bankers a lot of bankers are very busy right now. So it's, I think like getting their attention is difficult. We had to find one that liked us, that we had a historical relationship with, that understood us, understood the sectors we'd be going after, and thought that we'd be a good fit for them. And through that process, we ended up selecting Credit Suisse, who we've been really, really happy with, and they've been a great partner for us on this.
So can you talk about the process from, so you get the idea, now you pick the banker, and then what happens?
Well, luckily, we're not starting cold. So, I already have a fairly substantial operational team at Science, both on the finance and the legal side, as well as deal sourcing and diligence, et cetera. So, we're already in a position to be working with people's capital, working with companies, identifying investment, targets, et cetera. So it wasn't like we were starting with an initial team. Our legal team went through analysis on legal firms and chose their partnerships there. Our target team started thinking about the sectors that we want to focus in on, but of course you can't talk to targets until the SPAC is completed and publicly, listed in the market. Our deal team and myself, the leadership team, started working with Credit Suisse on our strategy, putting together our, our presentation to individual hedge funds that might want to participate in our kind of strategy on approaching targets. And then you kind of go through that IPO process, which I think is probably easier now that it's all through Zoom, right? It's probably saved us all a lot of time. So, yeah.
Can you talk about how the process was different than what you thought it would be?
Well, listen, I think in most cases I spend time with LPs that are investing into venture funds. It's a very long hold time with very limited liquidity and obviously a really high target net IRR. And it's really a deep relationship because when an LP decides to get involved with us as GPs on the Science venture fund side, it's going to be a 5 to 10 year relationship. We're really going to get to know each other and really understand the way that we think about businesses, the way they think about businesses, investing. So, but this is obviously much faster. We're obviously looking for long-term investors that want to invest in the, in the SPAC. But the reality is they aren't forced on lockup. They do have the ability to pull out of their positions. There's a lot more tradability in those assets, and so it's just a different pace of analysis. It's a different way to think about investing, and we're actually finding that quite a few of the investors are actually potentially going to be LPs in the venture fund too. They have interest on both sides of the table, which is really exciting, and I think that's great too as hedge fund investors start looking at the venture class.
The investor base, are they mostly U.S.? Is it mostly institutions, family offices?
That's a good question. And I'm always curious about what I'm able to disclose in that. I think most of it's probably public, but I think it's a mix of all that. It was U.S. and some international investors, some family offices, some institutions.
And on the investor side, was obviously you're just looking for people to buy your shares. So on the VC side, it's very important, that they're value add or at least not value detracting. Is any of that part of the?
It is, and we want value add here too. And we're pretty selective on who we initially went in with. I think the reality is that these are all highly sophisticated public market investors that have perspectives on sectors and industries. We're interested in their perspectives. So we like to have those conversations on how they're thinking about the market. If that better informs our strategy with companies, that's super exciting.
And so now you've got the money in the bank and you're out there now looking for companies. Can you talk about that process?
Yeah, I mean, we have a fairly specific and detailed process. You know, we have a roster of businesses we're very interested in. We'll reach out to management board members for introductions to the teams. You know, we document all of our points of contact so that we make sure that we're compliant with SEC regulations on how we're going to talk to these businesses and work with these potential managers or CEOs. You know, we have specific retention policies around data that we have to follow. So it's obviously very much more detailed than, you know, than venture investing. You know, we'll do an analysis. We're looking for not only a fit between, you know, obviously the economics of the SPAC and the economics of the business, but also an area where like the management team of the company that we're going to get involved in is really receptive to our management team, and if there's ways that we can help enhance their business and make their business stronger and better, you know, through you know, after the de-SPAC process. So we like to find areas where we're very complementary. We're not looking to just find something and shove it in the SPAC. That is 100% our goal. We really want to find something that fits. So, you know, we're spending time with the management teams. Obviously, there'll be a detailed financial analysis over the businesses, and we'll find the right fit, and we'll be excited to announce it when we're ready.
And when you go and you start having these conversations, what are the kind of major concerns of the folks that you're talking with?
I mean, listen, it's a hyper competitive market. There's a lot of SPACs out there that are talking to a lot of the same targets. So no matter what, you know, we're going to be, you know, showing how we can add value. They want to understand who we are. They want to understand the quality of our investors. They want to understand how, again, we're going to add value to that business after the de-SPAC process. And then I think also, just as you would imagine on any of these companies at scale, they're evaluating private transactions as well. So, you know, these are big companies. They have substantial revenue. They're typically market disruptors. Incumbents are looking at acquiring them. They should be acquiring them, to be, you know, to be honestly truthful. I think the SPAC market is what it is, often because a lot of these legacy businesses have not been active enough in M&A. I think a bunch of companies that were seeing SPAC should have been taken out by larger businesses before they ended up as a public contender to them. But you know, that's their loss and all of our public investors' gains, right?
Yeah. It's so look. Thanks for sticking around for the Q&A. I've definitely got some more questions as well. This is the last one before I open up the questions. And again, if you've got questions, put it in the chat, and we'll bring you up on. You know, SPACs. Do you think that this is, traditionally, as I thought of SPACs, they were only windows that, that opened up, when markets were really frothy. Now, obviously do you think that it's, that it's different this time, or, do you think that there, are windows there are windows for SPACs today and those windows will close?
I think that I don't know if it's different this time or not. I do think that the quality of companies that we're seeing that are interested in going through this process versus traditional IPO, these are very high quality companies. They're companies that I'd be excited as an individual shareholder in the public markets to own. They're companies I'm excited to be involved with. So I just generally think the quality of businesses that are at this later stage point, I think there's a lot of them, and I think they're really exciting. I think they're going to breathe a big, breath of fresh air into the public markets. So I think that's super positive. I think the SPAC process versus the traditional IPO process is more efficient. It's quicker. It has other, specific benefits to how the company thinks about going public. And I think it's actually, much more familiar to a company that's been raising private capital than going through a traditional IPO. So I think it'll continue to be a very attractive vehicle for some time.
Super interesting. So we got our first question from Eric Svensson. Eric, welcome.
Hey, thanks, Lou. And Mike, thank you. Really appreciate this.
Yeah.
So I co-founded a company called Blockstream 7 years ago. We started with an ambitious roadmap. Today, we view ourselves as a full stack Bitcoin company. We've made a lot of progress, but we have a lot further to go, and see us back as a way to help us accelerate our roadmap. So what should a founder like me specifically ask SPAC sponsors like you in order to figure out if it's a good fit, and if you're finding the right SPAC to help you achieve your mission?
So I think the first question is are you really are you ready to be a public company? Are your reporting and financial requirements in place? Do you have the management team? Like, there's all those considerations that you have to go through of like, okay, are we ready for that next step, right? So that's a big piece of it. The second thing is like, whomever is going to be sitting on your board and whomever the SPAC sponsor group that you're spending time with, you gotta make sure that they fundamentally believe in your business, that they believe in you, that they're going to bring meaningful partnerships, business development opportunities to you, that when you have strategic conversations with them, it'll be fruitful for you, and that they can help really expand you as a CEO and as a management team into growing that business when it's in the public markets. There's certainly a lot of SPACs that can just put stuff out there, but that's not really what we all need to do. We need to put quality companies in the market. We need to see them grow. We need to see investor appreciation when they end up public. So I think you're looking for a team that you really feel that can do that and really fundamentally understand your goals, where that business is going. I mean, this is a bigger relationship, right? So I think, the key is to spend time with them, get to know those, those managers and see if you really align on your vision.
Perfect.
Yeah, no problem. Happy to help.
Okay. Thanks, Eric. We got our next question from Maddie Greenspan. And so Maddie's a friend. I'm active for those who know me. And for the last about 6 months, I've been writing under the Quantum Economics banner, which is a company that Maddie started after many years as a market analyst for ePro. So Maddie, welcome, and you can unmute your mic.
Thanks a lot. I didn't know I was coming on. I'm actually just watching the GameStop hearing as well. I'm trying to do like 15 things at once. How's it going, guys?
It's
good,
great.
good.
It's great.
Sorry, I thought you had a question that you in the chat.
I did, yeah. So I wanted to ask, because it's very difficult for me as an investor to fathom, making an investment without really knowing what it is we're going to be investing in ultimately. And this is really kind of what my question is around. I mean, what drives people to put money behind something, which is, I mean, it's kind of opaque. They don't really know at the end of the day. I can understand that they trust you and everything like that, but like, they don't really know at the end of the day what it is that they're going to be investing in. Right.
Well, but you have to, it really depends on how where in the journey you're approaching this investment. But like for me, for instance, if there's some people I know, they're in the venture committee and they announce that they're doing a SPAC and they're publicly listed on exchange, and let's say that their exchange price is $10. I generally know that $10 price represents essentially $10 of cash in a bank account, right? So the first step is, oh my gosh, managers that I trust, have a public stock that's $10 for price representing $10 in cash. So that matches up, right? Now I might buy that stock because I fundamentally believe that those managers are going to find a great company. And when they merge that great company, it'll be worth more than the $10 of cash. When you start thinking about the value of the company, the value they bring, plus the cash will be contributed to the eventual public company, right? And so I'm believing that they're going to find a great target. If the stock trades down to 9, it's possible that $9 stock price actually does represent $10 in cash, right? Before that they've gone through the de-SPAC process. So you have to remember that the initial phase here is, the public traded value typically reflects the cash on the balance sheet of the company. And then, if you look at what's happened previously off sponsors, basically, identifying a target, going through the de-SPAC process and seeing them publicly list, you can decide whether the quality of the deals and the price they're paying for those companies creates future appreciation.
Got it.
Hopefully that's helpful.
I'm trying to put it all together here. So basically what you're saying is that the money that you're investing goes into the market cap of the SPAC, right?
Right. Well, it depends when you invest. If you're investing, through the private round before it's IPO'd, or you're investing in the public markets, but generally most SPACs price at about $10 a share, and generally that's going to represent about $10 in cash.
Okay, yeah, I mean, I suppose, there's a lot of extra $10 bills hanging around, so I suppose that's how that. I just remember in the 2017 ICO market, if you were around for that, and just had so many friends who were like, it's only $100. What do I care if I lose it or whatever, and then maybe it'll go to the moon. And a lot of what I see in the market today is kind of reflecting that. So. It's interesting, no doubt, but it's like, to me, it's very difficult to fathom, you know, I don't know if you're watching also the alt market at the moment. We've got, you know, several dozen coins that have gone from, you know, 200%, 500%, 600% since the start of the year. And if we go back another 3 months, like they're up 1,000% easy. And some of them have absolutely zero real world adoption. I mean, they're just speculative vehicles. So why should I put, you know, SPACs in any different category than those tokens? Because as far as I see, it's the same thing. It's capital that's yet to be deployed. And I don't know if it's going to fund growth or what growth it will fund and what my returns might be in the next 10 years from now.
Right. Well, I mean, yeah, I mean, I was around for the ICO market. This is 100% not that. Like, just to be clear, like, don't even use them in the same terms. These are not the same things. They need to be very far away from each other. They have no relevancy to each other. And I think if you investigated the underlying assets under the, you know, pre-de-SPAC SPACs that are trading on the public markets, I would suspect you will feel substantially more comfortable with them holding or maintaining some level of value than you ever would under a non-transparent ICO token. So you just got to put them in different buckets. Lou, right? I mean,
yeah, I would say so. When you were looking at other SPACs, I'm sure you were looking at other SPACs, and you said, well, yeah, what they've done is great. What they've done is great. Who do you think are good examples that somebody like Maddie should look at to really understand, okay, yeah, here are guys who did it right?
I mean, you know, obviously you can't get around Chamath right now. I mean, he's obviously the kind of leader in bringing high quality products in the SPAC market. I don't know what the Chamath SPAC index is up on, but it's probably worth pulling down some analysis if you want to say, well, what if I had invested in every one of Chamath SPACs from the moment that it hit the public market? What would my return look like today? But I'm guessing it's pretty substantially positive.
And you think, I mean, to Maddie's point, right? I mean, obviously the Dogecoin, and scratch your head about what's going on. And you can do the same thing with Tesla, right? At $800 billion market cap, and obviously, certainly Tesla, I think gets a lot of value just from its association with Elon. And so, to what degree, so you look at Chamath, do you think Chamath is benefiting from just being Chamath? And is that a long-term thing, or Chamath obviously is a brilliant guy. I mean, he's had lots of successes before. It's just, and it's just, I'm trying to think of other folks who have done SPACs that might not have had the star power that
Colin Kaepernick has done a SPAC. I mean, like for social justice, and I'm going, what is that? How do you monetize social justice? I mean, like, honestly.
Well, I mean, at the end of the day, you have to analyze the management team that you're going to get in business with in all cases. So you can decide whether you think that they're going to be a meaningful management team to drive a great deal. But also remember that, like, all these companies are public companies, and they have all the public company reporting requirements and all the transparency that comes along with those reporting requirements. Like, you actually can see the underlying business and fundamentals and how they're spending and deploying their capital in a pretty effective and transparent and investor protected way, which, I don't know who operates Dogecoin. I don't know how much they spend on salaries or income. I have no idea.
The network does.
Yeah, exactly. So, like, it feels to me like there's no one accountable for the long-term success of Dogecoin beyond the Dogecoin token holders. I don't know. For me, that makes me feel very uncomfortable. On the flip side, like, I absolutely know who's accountable for the success of Tesla or the success of any of Chamath's SPACs, because I understand the management team and I have transparency into their financials, right? I mean, it's why we like a regulated SEC-driven market, especially when it comes to public equities, because it generally will protect investors' interest and give you, a view into the businesses. But there's there's tons of sponsors. You do have to believe that the sponsorship group that you're backing is going to, is going to be able to find a compelling asset to acquire, right? I mean, that's absolutely, if you fundamentally don't think that they have the gravity, weight, or excitement or appeal to go to, get a Class A asset into the market, then it may not be the right investment for you, right?
Okay. Thanks for the questions, Maddie.
Yeah,
So, and if anybody else has questions, just put them again into the chat. But one thing that we didn't talk about was the private raise before the public raise.
Mm-hmm.
Can you talk a little bit about that?
Well, it's a good question. Am I allowed to talk about that? Like, I'm not sure that, I'm not an SEC expert, right? So, but there is a, as far as I understand it, and granted, this is one of my first IPOs that I've fully gone through. So, we use the same process that you go through a traditional IPO, talking to qualified investors, that process is obviously managed by our bankers to kind of select the initial investors into the SPAC.
Right, but isn't there an aspect of SPACs where there's a person or company that has investors that actually take some money and they put that into the SPAC as well, and that money is is at risk, more at risk, I guess, if the SPAC actually doesn't complete.
Right. Yeah. So there's a component to. Yeah, there's a component to a SPAC that's called at-risk capital. That's capital that we, as the founding team, need to contribute in whatever form, into the vehicle, so that basically, if we fail over a, call it, 24-month period to identify an appropriate SPAC target, that capital is at risk, and we will probably not get the majority of that capital back, right? So there's some risk to a management team that they have to put up their capital. If they fail on, obtaining their target and can't complete the SPAC process, there'll be some loss to that capital.
Okay. So obviously that gives you guys big incentive. Got a next question from Andrea Liu. Andrea, want to unmute your mic? Going once.
Yeah,
there
sorry. Hi.
Hey.
I wasn't expecting to be on camera, but no, I just wanted to ask about, I think you guys covered it just a bit now, but I was wondering if you could speak to the understood 20% of the promo for the sponsor, and whether these big names that are, coming in, and whether, there comes a point where it becomes too saturated. And also, I think you guys touched on what happens in the event of a failed SPAC.
Mm-hmm.
But could you do a deeper dive as to what constitutes failure, or what's to say a sponsor wouldn't then try to throw in a bunch of, well, I don't know. I mean, usually is it one particular target, or a target of a basket full of, I'd love to hear more, because we're doing a reverse merger, which is slightly different.
Mm-hmm.
But I wonder if you could also chime in on the difference, between a SPAC and, say, a reverse merger, which is a mini
Sure.
SPAC. Thank you.
Sure. No problem. So, so to one of your questions, there's definitely combos that happen. So there's certain SPACs that identify a single target, and there's other SPACs that use the capital to combine multiple targets. So we've seen both flavors, right? The other question that's a logical question as well, if you have this time frame, and this time frame's ticking down, and you have founder at-risk capital, what's preventing people from putting really bad targets inside of SPACs to basically prevent their capital? Well, depending, and you really do need to read the individual filing of each individual SPAC, but there typically are options for investor redemption. So there's some checks and balances in place to make sure that some garbage company isn't necessarily overpaid for, by the sponsor team to push into a SPAC in order to protect their founder capital. So, you do need the support of your investors to complete your SPAC, which means that there are protections to make sure you're not putting a very poor company into the public markets, and then obviously devaluing the investor's investment. So, but each SPAC has its own, rules around that, around the way that they do that redemption. Just as to your point on the 20% promote, there's different promotional components that both the investors, have to be, comfortable with relative to the founding team, and also the target company becomes comfortable with. And again, all this is going to be managed if you go through the SPAC process through your banking and legal team to make sure that all the things are done appropriate to the SEC. So there's a lot of checks and balances there. As far as how this is done relative to a reverse merger, that's kind of broad. Like, it depends on how the reverse merger is done. Certainly, I'd say from a top level perspective, companies going through the SPAC process that are going to become a public company, they need to be public company ready. There are certain audit requirements, certain financial requirements, certain components around, the board and obviously the management team, the way they present the company, the efficacy of their data, et cetera. And so you can't just jump into this. Like, it's going to create a whole bunch of problems if the company really isn't ready, and suddenly they have SEC grade level reporting to comply to, and they're unable to do it. So there's a lot of things to protect, I think, poor companies from being pushed through these vehicles.
Yeah, and earlier you made a reference to at-risk capital. what does that usually look like? And as a general question, with all these SPACs, it's raised 38 billion and growing, and whether you think of that as a bit of a harbinger of some maybe, bubble bursting to come.
So I think, the at-risk capital, it's going to be specific to each individual SPAC, so that you'd need to kind of read up on each individual SPAC perspective on how the at-risk capital is being handled. But it's not minor, right? Like, it's going to be meaningful. If you think about the amount of at-risk capital tied to 38 billion in SPACs, it's a meaningful amount of money, right? So the management teams are hyper compelled to do a good deal in the market, right? As far as volume goes, as far as I can tell, I think that corporate M&A has been really slow. I think there's a lot of companies that are super meaningful companies that are kind of late in the market with 9 figures and greater in revenue. They probably should have been acquired. They haven't been acquired. And so I think that 38 billion capital will find meaningful assets and they'll bring them into the public markets. And I think that's going to be totally okay. I don't think it's a harbinger of being overfunded. I think it just means that there's a lot of very meaningful late stage businesses that are still private. And that's probably because late stage private equity and late stage private venture enable those companies to stay private longer because there was so much capital. So you increase the amount of late stage private, private capital available, you decrease the amount of corporate M&A. What do you end up with? Like a bunch of super huge late stage private companies that suddenly need to find their way to the public markets. Thus the SPAC vehicles created with peers like us that know those management teams and kind of shepherd them through the process. Like, I think it's just a release of the dam.
Interesting. Thanks, Andrea.
Yeah.
I got a next question from Andrew Worthon. Hey, Andrew, I know your camera doesn't work, but you can unmute your audio. There you go.
Perfect. And thanks for saying my last name correctly. I appreciate that. Great info session. And this is really helpful. My question is more along the lines of with the time and capital commitments of the SPAC management team. First, is there a disincentive? And if there is, how do you deal with the disincentive to find a company before the time period expires? It seems like there's kind of more of a pressure to just obtain a company at some point in that process, just so that you don't lose kind of some of the sunk costs that you put into it.
Yeah, as I said, like, certainly, SPACs that are getting late in the day are going to be hunting more aggressively for companies for sure. There is investor redemption provisions that could potentially block a SPAC transaction if the management team tries to shove a very poorly constructed deal, into the SPAC. So, there are protections, in that place. But then also have to realize that, for people like me and my broad team, we've already had a long career on investing other people's capital. We expect to have a very long career in the future, deploying other people's capital. If we do a bad deal and it underperforms, it's reputational damage, it's investor damage. So, beyond the actual protective provisions around investors, there's also a massive amount of reputational risk if you end up doing poor deals.
Awesome. Thanks. Appreciate it.
Yeah.
Okay. Thanks a lot, Andrew. So I'm going to ask the last question. I'll just give you an opportunity, to the degree, obviously, you're out there, talking to investors, about your plans and how things are going. So, what you want to leave folks with regards to the SPAC and why they, I'm excited about it because I know you and, how massively, talented, you and the entire science team is. But
yeah.
What do you, what
how do I
have people remember?
I think that the big takeaways right now in this are like, there's a bunch of very exciting late stage private companies. I think a handful of them will perform very well in the public markets. I think that's exciting. There's a bunch of venture-minded, management teams like ourselves that are now entering our careers into those public markets, which I think is also really exciting. I still love the kind of balance that we've chosen to focus on, which is that hyper early stage investing and hyper late stage investing. I think for me, it's an exciting place to be. I think if management teams misuse the SPAC vehicle, to everyone's question, and put in poor products, it'll probably destroy it for everybody. And I 100% want everyone to know this has literally nothing to do with ICOs or tokens. There's no comparable between the both. Don't think of them as the same thing. They are complete polar opposites. This is not the same thing at all. And then obviously, before you make any, nothing that I'm talking about gives any investment advice to anybody. Make sure to do all your own independent research on anything you decide to deploy your capital into.
Okay, well, look, thanks a lot. I think you really shared a lot of great knowledge. So really appreciate it. And thanks to everybody for coming. We'll see you later.
Thanks, everyone. Take care.